Hey guys, and welcome back to the Dutch Investor channel. Today I want to give you something different. I want to give you a book summary and my thoughts on it. The book I'm going to be talking about is called 100 Baggers, Stocks That Return 100 to 1 and How to Find Them. So basically if you invest $10,000 into a stock, after a certain amount of time you will have $1 million. That's basically the thesis, and that is the kind of stocks the author called Christopher Mayer was and is probably looking for. So I enjoyed this book. It was easy to digest. It was a quick read for me. He wrote it very, I'd like to say like easy to understand. Like it's not very financial terms and all that. So it's very easy. I think it's probably a good book even if you are a beginner investor to start reading. And yeah, the every chapter he basically tells you a simple or like a story about an experience of his or about the research, and then he concludes with why it matters. At the end of this book, he gives 10 reasons that are, I guess, the principles of how to find 100 baggers. I divert from it a little bit, but I think 90% is basically what he states there. So I'm gonna walk you through it, and I hope you guys enjoy it. If you do enjoy it, please consider leaving a like. Really helps me out. And yeah, let's start with the first principle. High return on capital with the ability to reinvest. So high return on capital, you can basically look at return on invested capital or return on equity. And what is important here is the second bit is the ability to reinvest. So the moment you have a high return on capital and you pay most of your profits to your shareholders through dividends, then your return on capital is going to stay the same. So how do I mean? What do I mean with this? Let's say you have an equity of $100 and you have a profit of $10, then your return on equity is 10%. If you go next year and then you haven't paid any dividends, then your equity will be $110. So if you want to reach 10% return on equity again, then you will need to make a profit of $11. If you have paid out those profits in dividends, then your return on equity will be exactly 100 again. So your return on capital, if you have a profit again of like 10, then it will be 10% again. So there is no need for you to make your profits grow to get a high return on capital. So the ability to reinvest is really important with this one. I didn't consider giving you an example with this one. If you prefer it, then let me know and I will make sure to do it in the next video, talk a bit about this more because I think this is a very important topic. The second principle is that you have to look for the 100 baggers. So I guess this is basically like it was a very short thought or a summary about it, but I guess that's it. Like you cannot expect to just have them come to you. No, you have to keep searching for them, and it's not like okay, I'm gonna get a few and that's it. You cannot invest in like 10 companies and hope they're gonna be 100 baggers. No, it's gonna be very hard to find 100 baggers because there's not many out there that will turn into a 100 bagger. So you have to look for them. It takes a lot of time. Third principle, they need to have growth, and in particular in earnings per share and revenue. So I guess if you have checked my previous videos, you know what I think about growth. I prefer to look at free cash flow growth, but when you are still growing as a company, then these are very important metrics as well. So he wants those numbers to always be able to grow. Something you may notice here is that he is referring to earnings per share and not earnings, and the reason for that is that if your company doubles the earnings per share in 4 years, but it also doubles the stock or the shares outstanding, then the underlying growth hasn't been that great. So you want to have a company that is growing their earnings per share and not just their earnings. That's basically the important bit of this. Fourth principle is that you want to invest in companies that have a lower multiple, or at least that is preferred. He did mention that this is not the only thing you should be looking at, and that the growth and the high return on capital is more important. But he gave a very extreme example, like if you have a PE ratio of 50 and they keep growing, then to get a 100 bagger with that earnings, and in like, let's say 20 years they trade at 25 as a multiple, then instead of having 100 times earnings, you need to have 200 times earnings. So that's going to be very unlikely. So that is something that you need to keep in mind as well. But for me personally, I am a bit tilted, I guess, towards finding lower multiples. Like, it is my preferred investing style. But what he mentions, and that is very interesting, that the high return on capital is probably more important, or in his opinion is more important. And when you think of Warren Buffett and Charlie Munger, Warren Buffett used to be a very deep value investor. So he would focus on really low multiples and then just try to get most out of it. And Charlie Munger actually was the one who convinced him that no, you need to focus on companies with a high return on equity so that they can make you a lot of more money. So yeah, they have an opinion on that as well. But if you combine these two, the last two, what you get is what he called a twin engine. And at the end of this video, I'm going to give you two examples of that. But what it basically means is that if you combine these two, you can multiply the results. And I'm just going to stick it to that. Just keep that in mind. You can multiply your results. So I will show you that in the end with two examples. Principle number 5. Moats are a necessity. If you want a company that keeps on growing, that will constantly grow like the next 10, 20, 30 years at 15, 20, 25% per year as a rate, then as a growth rate, sorry, then the company needs to have a moat. And he gave it's a nice book to read, and to read about the moats, because he gave 5 examples on different kind of moats. And yeah, you need to have a moat because you don't want your company to be disrupted by a newcomer, like an up and coming company, an upcoming company or an up and running company. But yeah, moats are a necessity, and you know how I feel about moats as well. So I think that just to read this chapter completely in the book is very nice as well, because it gives you an idea of what to look for when you're looking for moats, because, and that's what Christopher stated as well, it's very hard to locate certain moats, because it just, sometimes they're not out there. Sometimes it's not that clear that they have a moat. So it's good to develop your own skills to find moats, and the book will help you with that. Principle number 6, smaller companies are preferred. You know, I'm always looking for small caps and mid caps, and you won't see me investing in the $1 trillion companies that are out there right now, because it's just, if you want 10 times your investment in the next 10 years, then it is more likely that you will find that in a smaller company than in a $1 trillion company. So I tend to look for smaller companies because they have more room to grow. The caveat there is that it is harder to find a good small company, and obviously they are a lot more volatile, so you can just have like lose 30% in 1 month, and yeah, you need to be able to deal with that even if there is no outbreak or something like that. So keep that in mind. But yeah, if you want to invest for the long run, the smaller companies will be probably a better place to look for those growth companies. Number 7, owner-operators are preferred. What does he mean with that? Is that he wants the companies to be run, so the operators, by owners. So if you think back of my checklist that I shared with you a couple of weeks ago, or well, I guess it was just 1 or 2 weeks ago, then yeah, I like to ask a lot of questions about management, and one of the questions that I always ask is that how much skin do they have in the game, because the more skin the CEO and other management members have in the game or in the company, the more likely it is that they are going to they have more incentive to do a good job in running the company. If they have very little shares in the company and they have big bonuses, then they're more likely to do what's best to achieve those bonuses instead of doing what's best to make the company grow. So I really like this point, and this is always something to keep in mind. So I'm glad that I am on the same thought as Christopher on this one. Use the coffee can approach. Principle number 8. This is basically time arbitrage, if you know what that is. What he was referring to in the coffee can approach is that you need to imagine having a coffee can, and you need to stuff money in it and then put it under your bed, and then you don't look at it anymore. So you need to give the investments that you've done, you need to give them time. And we're not talking about months here, we're talking about years and probably decades to get the results that you're looking for. So use this coffee can approach and make sure to give yourself and your investment the time to grow. Principle number 9, develop a really good filter. And with a filter, it's like you need to, there's a lot of noise out there. You get, if you subscribe to anything, if you just, you follow CNBC or Yahoo Finance or like Motley Fool, you can get like 10, 20 stock recommendations per day if you want. Sachs is also known for that one, to give a lot of stock recommendations. But you need to filter these out, and you need to find only the really, really good ones. And once you find the good one, and that is also the thesis of this book, once you find a good one, you need to bet big. You need to go like heavy on it. And you should, there's a part in this book when it looks at successful money managers. And you can think of Seth Klarman and stuff like that, Charlie Munger and all that. And I think he gave like 6, 7, 8 examples of investors and how they have allocated their portfolio. And you could see if they have, some only had like 4 stocks and they were very heavily invested in it. So like 50, 60% in a stock. And well, you know, I'm that crazy about DGOC. But that's also because I'm still running, like still up and coming and still making my portfolio. But they actually had like a lot of money and still decided to do that. So if you have a good idea and you believe in it, you need to bet big on it. But in order to do that, you need to develop a really good filter, because you do not want to make a mistake when you are going to bet very big. 10, and that's the final principle, at least for this video. If you want one more, there's one in the book, but I didn't really feel like telling you about that one. And it's more luck based than actually skill based. And number 10 is be reluctant to sell. This is kind of in line with number 8, that you need to use the coffee can approach. But you need to be reluctant to sell in both ways. Like if it drops, then yeah, if you were confident about the company, you need to buy more. But you also need to give it time, so you need to not sell. And if you sell in the short run, and even if you have found a very good company, and that's what the book states as well. If you have found a very good company that's going to grow for a very long time, then the best time to sell is probably never. So you need to be reluctant to sell, and you need to, because you are very likely to sell because you want to make money. Because that's probably one of the reasons why you went into investing anyway, because you wanted to make money. But let the companies make money for you. That's the best thing you can do. So as a final part, I want to go to the twin engines. And if you remember what they were, it was growth and the lower multiples preferred. But what if you have invested in a company with a lower multiple and it is still growing, and in the future it's going to trade at a higher multiple, then you can multiply both those results for your own investment, return on investment. So I'm going to give you 2 examples. Let's start with number 1. let's think of a company that has a price to earnings ratio of 5 and it is growing at 20% per year, and the future price to earnings ratio, so in 10 years, it's going to be 15. What would that look like? It would look at, you can see what you do is you divide the future price to earnings ratio by the current PE ratio. So 15 divided by 5 is 3 times multiple growth, and this is basically a formula to see how much, if you invest $1 in it and it grows at 20% per year, and this is the amount of years, then the $1 will be worth $6.20, give or take. So if you invest $1, you will get 6.2 times your investment as growth. But why is it these are the twin engines? Because you can multiply these numbers and that will be your return on investment. And you can make any calculation and you will know that it is true. So you can try it out with your own numbers. So your return on investment is 3 times 6.2, and then you have 18.6. So that would mean that you have an 1,860% return on your investment. So if you invest $10,000, you almost have $200,000 10 years later. That's not too bad, huh? So let's go to the second example. And this is probably important because this is basically the scenario with some companies that we're in right now, and they are still looking appealing because they have such a great growth ratio. So let's think of a company that has a current price to earnings ratio of 30, and you can I think you can think of Google, Amazon, Microsoft, the companies like that are currently trading at a very high price to earnings ratio. Their underlying growth is still 20% per year, and their future PE ratio of 15 is going to be 10 years, because 15 tends to be the mean. Like, so let's say that we're going to make sure, or we're going to assume that they return to the mean. Then you divide the 15 of the future PE again by the current PE, and you have 0.5 times your multiple growth. And then the growth stays the same, so you have 6.2. So your return on investment is 0.5 multiplied by 6.2 is actually 3.1, and that would mean that you would have a 310% return. So it works both ways. It can accelerate, but it can also decelerate. And why is this important? Well, because there's going to be times where it looks very attractive to invest in a company that has a big growth number, and you're going to think, well, I'm still going to make money. And sure, you're still going to make money even if it trades as a lower multiple 10 years from now. But is this the return that you're looking for in those investments? Probably not, because you're investing in a company because they have like a 20%, 25% growth rate. So you're looking for a better return than just that return. And this is how you should look at it. But you can also look at this and think back of the past decade and see how these companies have grown. Have they grown with an underlying value? Or have they grown from their current PE to a future PE that was just trading at a higher multiple? And with this, I'm just going to leave you. I think you should look at that, see if you can find some data on it. Because if I think back of Apple, I believe it was there was a time where it was trading at 8 times price to earnings in 2018 or 19 or something, and right now it's trading at a far higher multiple, and that means that investors were just willing right now to pay more for the company than they were back then for the growth. But that means that if you have like 100% return, it wasn't based on the growth number, it was based on just a higher multiple that was trading at. And if you are lucky enough to find a company that is trading at a price to earnings ratio of like 1, 2, 3, and in 10 years from now it's going to be a great company and it's going to trade at 25, 30 PE ratio, that means 10 times, then if you have an underlying growth of about 30%, then in 10 years you could have your 100 bagger. But obviously it's going to be very hard to find a company like that. But nonetheless, I think it is very much worth looking for a company like that. So that's going to be it for the book summary. Let me know what you guys think of this, and if you want to see content like this in the future. Again, this book was a very quick read, easy read, very nice to digest, and has a lot of valuable information for beginner investors. And it doesn't hurt for you if you are an experienced investor to read this book either, because you may just find something that you think of, hey, that's also very important, and I didn't give that much value to it. So if I think of me right now, I put always a little bit more emphasis on the lower multiple, but this book convinced me that the high growth, even though I always look for at least 15%, I think high growth is actually, if I have to choose, but I'm going to look for both, if I have to choose, I should lean more towards the high growth part. So that is something that I will keep in mind, and that's something that I'll always take away from this book. So if you have read this book, feel free to let me know what you think of it as well. And if you have any preferences in what you would like to see next, also feel free to let me know down in the comments below. And for now, I wish you guys a great evening.